Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
How's it going out there? It's September 4th. And I'm Frank Curzio, host of Wall Street Unplugged. So we're bringing the headlines and tell you what's really moving these markets. Supposed to have Daniel Crease join me today. But unfortunately, we had a bad storm that knocked out electricity like 3-4 times in a row in a 20-minute span yesterday, which knocked out some of the cameras. And by the way, for any of you that actually do any taping, and Daniel and I were talking about this, that do any kind of taping, music or whatever, it's when you have sound systems, and we kind of control the studio here. So when you have sound systems or a studio and everything, every single time, no matter how it's set up absolutely perfectly, doesn't matter, you're always going to fucking run into problems. I mean, always, no matter what. I'm telling you, it's crazy. It's a pain in the ass. Musicians know what I'm talking about. People who do camera work know what I'm talking about. But it's crazy. Anyway, gonna have Daniel sit this one out. He'll be back tomorrow. Wall Street Unplugged Premium Podcast. But let's talk about the markets. Markets fell sharply. Everybody worried. Even Tom Lee is bearish for a couple weeks. It's probably a downturn in September, maybe 5 weeks, 6 weeks. It's going to be a great buying opportunity, but everyone's super, super bearish. And what I learned in my 30-year career is, or one of the biggest mistakes I made, I should say, is you never want to be on the side that everyone else is on. And man, it's hard to find someone that's bullish right now. Because when you look at the data and you look at everything, I mean, you talk about Nvidia crashing, right? Fell 10%. AMD on semi. I mean, all these big semiconductors fell sharply. It wasn't just AMD or Nvidia. There's a whole sector. The SOX, which is the ETF that tracks semiconductors, had the biggest one-day drop. And I want you to think about when. So a lot of people say, since last year, since 2 years ago, or 5 months ago, or whatever. In the market, biggest downturn since a month ago. But the SOX had the biggest one-day drop since March 2020. That's how much it fell down. You could say, hey, listen, it went up tremendously, and you're right. Just like when people say home prices are crashing in Florida, they're down 7 or 8%, some places 10% from their highs. They're up 100% in 3 years. When you're looking at the markets and you put your TV on, holy shit, the negatives. I mean, look at the consumer stocks. Dollar Tree down 20%. They warned the full year, now expecting earnings of $5.40 compared to $6.56, which is a big warn. That stock was 150, trading around 66 right now. I don't know who owns that stock, especially after the horrible report from dollar stores. I mean, let's get real. These are the exact same fucking stores. There's no difference. It's not like somebody passes a Dollar Tree and say, no, it's a Dollar Tree. We got to go to Dollar Store. No, they're all exactly the same. So if one warns, you know they're all going to warn. And yes, Dollar Tree said it's more than that, tornadoes and this and that. But, you know, again, those are charges or whatever that people kind of, analysts ignore when you have these one-time events and they strip them out or write-downs and stuff like that. You want to compare apples to apples. But it was bad all around. You look at these things and it's like, it's just crazy. Then you turn on TV, Buffett selling more, Bank of America selling more. You have Goldman Sachs cutting its workforce, also cut its copper forecast due to continued weakness in China. That's what they're projecting, continued weakness. Wow, sounds familiar. Good job. You're only a year late on that. By the way, more news out of China just abandoned its 26 high-speed rail station project. I mean, it really, really is a disaster over there. Think about the worst possible scenario, and it's worse than that. I mean, who was it in Armageddon? One of my favorite movies. I love that movie. So entertaining. But people are like, you can't launch a rocket ship onto a meteor and blow it. It's entertainment. It's entertainment. Relax. But I remember when one of the guys asked, what are the scariest conditions? Or what can we expect when we get up there? And he told them, he's like, it's got to be like minus 100 degrees to 200 degrees and razor blade rocks coming at you this day. He's like, okay, scariest place imaginable. Scariest place imaginable. That's what China is right now. As bad as you think it is, it's much, much worse. Two bad manufacturing reports, which really pushed down the markets. We're finally seeing, like everyone wants the economy to slow down. We talked about this. Daniel, I pounded the table on this. I said, it's the reason why stocks sell off when the Fed starts cutting, because you're thinking, wow, interest rates. And everybody said that was the bullish indicator for all 2023. This is why stocks were going to surge in 2023, because the Fed's going to start cutting, and they never cut, and stocks surged. If they would have cut, we'll probably see the markets come down. Because when the Fed cuts, it's telling you that they believe the economy is slowing. And then when you get these two economic reports showing that the data is slowing, now you see the narrative switch. Holy shit, we need things to slow. This way inflation comes down. Now you see that come down where bad economic reports are turning out to be bad for the stock market. And you're seeing all these companies, even the ones that raised their guidance a little bit. You look at Walmart, Target said, look, we're seeing the consumer slow down. We're able to manage it because of what we're doing, and we operate good businesses. But everyone is saying it, everyone. And we still haven't touched interest rates, even though the market's kind of foreseeing that. We're seeing rates drop tremendously. Were they 2-year? What I hear? 14, 15-month lows now? But the manufacturing reports was the ISM and the PMI, Purchasing Manager Index. All you need to know is the number 50. When they're below, it shows contraction. When it's above it, the economy's healthy. If it's 51, it's a great economy. If it's 49, it's terrible. We're in a recession. That's how everybody looks at it. Kind of like how a recession is defined. So if GDP grows for 3 straight quarters at 0.1%, it's not a recession. We're fine. But if it declines 2 straight quarters at 0.1%, it's a recession, right? It's defined as recession. But both of these reports came in under 50. Now people worry about the tech slowdown, the global slowdown. When you see Germany's an absolute disaster. Do you see the car reports? Holy shit, they're down tremendously. Ford, another recall, good for them. Holy cow. Recalling tons and tons of vehicles. And these are the vehicles that they pushed out because of COVID that they didn't have the parts for. And they probably said, hey, you know what? Don't worry about that chip. Let's just get it out. And now you're seeing all these recalls from the supply chain disruptions, and they're coming in from 2021, 2022. Those are the cars. Those are the cars where we had trouble getting because supply chains were down. Because the Fed said, hey, let's spend like $3-4 trillion after we open up everything, after everything is good and assets all-time highs. Let's continue to just fuel the market with trillions of dollars. That's not going to be a problem. We're not going to see inflation, right? It's transitory. We're not going to see inflation. We're not going to have supply chain concerns. No, absolutely not. Everyone's going back to work, and you're getting $1 trillion stimulus into the market. That's not going to be a bad sign. Nothing's going to happen. We'll be fine. Zscaler warned companies may cut spending. They're a little worried for its products, down over 15% today. Dick's Sporting Goods, pretty good quarter. They just warned of a consumer slowdown and said shrink hurt them. Shrink. Why do they call it shrink? And I find that so interesting. I touched on this a couple of times, but why they call it? Why don't they just say that it's a bunch of low-life pieces of shit that steal our merchandise and there's nothing we can do about it? We can't hire more security guards because if security guards stop them or hit them, they're going to get arrested and thrown in jail for life. So we can't. Think about it. If someone's robbing your store, in Florida, if you rob a store, you get shot. You see the videos everywhere. People get shot. They got guns behind the counter. You're going to get shot. No one's going to come into your store. If you come in the store, you're going to get shot. You better be prepared. You break into someone's house, you're going to get shot. You get shot in the head. And the cops say, listen, aim for the head. This way he doesn't get up. That's what the chiefs tell you. Aim for the head, shoot him, and it'll be great. That's what you need. They say it. That's what you need to do. You got to protect yourselves. Every place else, how can you protect your store? How can you let people, they don't even run when they steal the shit. They just go in there with a bicycle and put everything in the thing and go out. They don't even care. How does this happen? And it's not just Dick's. I mean, Walmart, Target. You've seen stores close all over the major cities because of this. Is anybody paying attention? But Dick's is down over 10%, although the numbers I thought were pretty good, but expectations were high. The stock's been kicking ass lately. More negative news. U.S. Steel says it's closing mills, and they're going to move their headquarters out of Pennsylvania if deal collapses with Nippon Steel, if the government blocks it. And the government loves blocking deals these days. But you're looking at bad economic data all around, starting to show up in stocks. We're seeing it. We're seeing this slowdown. And by the way, these risks that I'm telling you about, I didn't even mention Russia, Ukraine, Iran, Israel, geopolitical risks, Oil is now below 70, pull back below 70 today. Massive debt that's out of control. The carry trade in Japan, people worried about that again. All this stuff, all of this, all these negatives, these massive, massive negatives that you have to worry about, that you have to be concerned with. And you know what? I'm going to check it right now. And the market's up. The market's up. How could it be up with all of these risks? Now, I can tell you something. Everything that I mentioned to you, people are talking about. Which means what? If I taught you anything, it means it's factored in. Even when it comes to Nvidia, Nvidia got smoked, lost $300 billion in market cap. There's only 25 companies. But one day loss of $300 billion. Like when we put this in perspective, it's pretty cool just to see how big that is. Yes, we know $3 trillion valuation, whatever. We know. One day loss of $300 billion. There's only 25 companies in S&P 500 with a market cap over $300 billion. That's like Netflix going to zero. Chevron going to zero. AMD, Merck, Pepsi. Those are pretty big names. That's the market cap Nvidia lost in a few hours when the market was open. And now the Justice Department is going after Nvidia. Surprise, surprise. So they sent them a subpoena, looking at Nvidia being a monopoly. Maybe listen to this podcast, because I said last week, Nvidia had 80% market share in GPUs last year. You know what it is this year? 88%. It's gone higher because they have the best product on the market. I'm not sure what the Justice Department could do. And think about it. Companies can choose whoever they want to choose to buy the products from. And this isn't Microsoft, where they own the software in every computer. And you could use other companies where it wouldn't hurt your performance or anything. It's not like Google, 80% of the search market forced, where Apple signed a deal with them as well. And they pay, I don't even know, what is it, $5 billion a year? Whatever they pay them, billions and billions a year, Google pays Apple. Just so it's embedded in the phone. That's your search for Google. I mean, this is different. If the Justice Department says, hey, you know what, this is a monopoly, I mean, it's not like they can force the biggest hyperscalers to buy GPUs from their competitors, which are AMD, Intel, Samsung. Intel, I can't believe I said that name. Holy shit. I think they may lose that $8.5 billion in funding. I'm hearing that and giving the rounds because they have to meet certain qualifications, and now they look like they're closing fab plants. What a disaster over there. But if you look at the hyperscalers, think about that. They're going to have to sacrifice performance if they're forced to use their competitors' products. But when I look at this, I don't see abuse here. Like NVIDIA forcing companies to use their GPUs. They just work harder than everyone else. They come with the best chips that are 10 times better than the competition. However, with that said, when you look at NVIDIA and you see the market coming down, stocks coming down, the Justice Department coming after them, that was at the close of yesterday, it adds fuel to the fire with tech stocks melting down. And even the large cap tech stocks, they were down about 3% yesterday. They weren't down like the 7, 8, 9, 10% like the semiconductors. But even when I look at NVIDIA and you say all the risks I highlighted that we're talking about, what's the biggest risk here? Everybody keeps saying it. When it comes to technology, there are concerns over CapEx. It's going to slow down. It's going to slow down. It's going to slow down. JP Morgan came out with a great note today. It was pretty cool, well-researched, comparing this current tech boom to other areas when it comes to CapEx spending and the percentage dedicated to one company. And if it hits a certain percentage, that's usually calls for the top of the market. And, you know, we're still a little bit away from it compared to the dot-com bubble. But I got to tell you something. There is zero evidence. There is zero evidence that hyperscalers plan to cut CapEx on AI. There's zero evidence. Zero. Ask Taiwan Semi. Ask all these companies, every one of them. I mean, there's zero. I mean, you could say eventually they're going to have to close it down. They're not seeing the benefits. Believe me. Guys, these people, these companies know every single thing that 7 billion people are doing at every single second. They don't make mistakes anymore. They're not going to overspend on AI because they think they can't make money off it. They're already seeing massive benefits. You're seeing layoffs. You're seeing, 400 million people use Meta AI, by the way, which is a slower system. So what are they going to do? They're going to force it to go slower if the Justice Department gets its way? Can't buy Nvidia chips to catch up to everybody. But you're telling me that it's not benefiting them. They're not seeing that huge return. And you know who's saying that? A lot of economists who know nothing about stocks. When you listen to these companies and what they're doing, this is a fear-based sell-off based on something people believe is going to happen, not something that's happening. We'll see the slowdown. We talked about slowdown. Daniel and I cover stocks all the time. We see people warning. They're warning of the customer. And customers start spending a little bit less. Seeing delinquencies go a little bit higher. But banks are doing fine. I'm not telling you it's a rosy outlook. I'm just saying that the fears are based on something that people believe will happen or it's going to happen in the future. But if you're selling Nvidia here, sell Nvidia because you think the multiple is going to come down. Say, you know what? It's a little too expensive. And when we compare multiples, we compare them to other stocks. So we look at Nvidia trading at 32 times forward earnings, you don't say, well, compared to the S&P, it's really expensive because the whole S&P is not growing as fast as Nvidia. But you would compare it to other technology companies that you might put in your portfolio, like an Apple. I mean, you can compare it to AMD. AMD is more expensive. A lot of these companies are more expensive than Nvidia on the chip side. But even if you look at the hyperscale, if you look at the big companies, the big tech, you're looking at Apple, Microsoft trading at similar multiples, growing much, much slower than Nvidia. But maybe you say, you know what, these multiples with this high interest rate, which is what I thought would happen over a year ago. I said we should be trading at over 20 times. 20 times multiple is an expensive multiple. That's a premium multiple past to historic, which is around 17%. But you deserve that multiple when interest rates are zero. When interest rates are where they are, we should be trading around 17, 18 times. But we're trading at 21 times now. Okay, the whole multiple of the market should come down. That's what you can say, okay, stocks are expensive. That's fine. That's your argument. You got a good argument. But to say, hey, you know what? The whole tech sector is going to collapse because these companies are going to cut CapEx on AI. There's no evidence of it. It could happen, but there's zero evidence of that, of Apple, of Microsoft, of Tesla. I mean, look at Twitter with Grok, which is the X platform. I mean, look at Google, Amazon. None of them are cutting spending. They're trying to find ways to compete with Nvidia. But they're not cutting. They can't cut because if they cut, they fall behind everybody else. But these tech companies, they don't make mistakes. They know every piece of data, everything that is going on. They understand it. They understand how much money they're going to make by spending $1 to $7 billion on AI and how quick that return on spend that they're going to generate in the next month, in the next 3 months. Maybe they don't expect the rate return in 6 months to a year. They know. Are you kidding me? Look what we know how to do with AI right now. You don't think they know? Spending $7 billion and having the best engineers, thousands of them, the greatest talent in the world that knows everything about AI. They have the monopoly when you're looking at 5, 6, 7 different companies. Are you kidding me? Do you really think that they're going to overspend on AI? Because whoever's going to win at this race is going to be the biggest company in the world based on market cap. They're going to take market share from the rest of these guys. I don't care if they're in kind of different industries where you say, well, Microsoft is software and cloud and, Amazon is cloud, but yet I wouldn't call Apple a cloud company, even though it's a cloud division. It's more a hardware company, 55% of sales. But all these companies, it's this race to win because they all have so much data that they're going to analyze. So if you're selling stocks or you're selling Nvidia, like just the narrative, again, it doesn't matter what the narrative is. You could say whatever you want. Just like everyone said, the market's going to go up tremendously in 2023 because we're cutting rates. The Fed didn't cut rates and the market went up tremendously. Pat yourself on the back. You were right about the markets. You may be right that some of these technology companies could fall from here, but it's not going to be based on we're going to see a slowdown in CapEx or we're seeing a slowdown in CapEx. Again, there's just no evidence of that. I don't know what it is to talk about. I listen to the conference calls. Probably more in depth than 99.9% of the people out there. That's why you probably listen to this podcast. They break this stuff down. But if the overall multiple comes down, that's fine. But let's see, because Nvidia should not be trading at the same multiple as Apple, as Microsoft, it should be trading a much higher multiple because it's growing earnings over 100%, which, by the way, they had to delay their main chip. If they didn't have to delay their chip by 3 months, they would have had another $3 to $4 billion. $3 to $4 billion in their guidance would have been added to their guidance if they didn't have to delay their Blackwell chip 3 months. Holy shit. So let's see how this plays out. Because not everything is terrible. Now, we're going to get a good look on Friday, which is a jobs report, which is pretty important all of a sudden. Nobody really cared. You can look back. You can look at this so many different ways. The data is a data, right? We're at 4.3% unemployment. You can say that still historically, we have full employment. That's a great number. Or you could say that it's going up a ton. It had a 3 handle on it for, how many years? And now the last 3 months has a 4 hand. That's 4.3. And usually when you see unemployment rising 4 months in a row, 5 months in a row, it's a sign that, that's when recessions hit. But could you compare? Again, it's a data. It's how you interpret it. Would you say we're going to be in a recession with unemployment rate at 4.3, 4.4%? I don't know. But we just had 2 pretty weak manufacturing reports. Today, we had some good data on durable goods. But now economic data, people are paying more attention to. So they're saying if we come out with a good jobs report, which, by the way, could you define what a good jobs report is? I have no idea what a good jobs. I really don't. I'm not kidding you. I don't know. I covered this shit for 30 years. I don't know what a good job report or what's considered a good job report for Friday. I don't know. I mean, if jobs come in stronger than expected, is that good? So that could show inflation may start rising again, and the Fed's only going to cut by 25 basis points. If it comes in weaker than expected, is that good? The Fed may cut by 50 basis points. It could show that the economy is really slowing, and maybe, hey, we could see a recession pretty soon. I have no idea. We've spun this around where any jobs data or the number that comes out is going to be good. The estimates are for 160. I think they're expecting 4.3 unemployment. I will say this. When we hit 4.4, 4.5, I could see sentiment-wise, you're going to be like, holy shit, we're getting closer to 5. That's a big deal. You haven't seen that in a while. I'd like to look that up. 5% unemployment. Remember, 4.5 to 5 used to be considered super low. Now, since we're coming off a base of 3, 3.1, 3.2, now it seems like 4.3 is high. But over 4.5, we hit a 4.5. I can picture people saying, wow, maybe we get a 5 handle. We got to lower rates a lot quicker. But what is a good jobs report number? What is a good number? I mean, I would think if it comes out like bad, really bad, that's going to push the market lower. I mean, if you're forcing the Fed's hand for a 50 basis point cut, which I still believe that's what the Fed should do because they're way behind. I mean, look, the bond market's telling you that, how far behind you are. You can go 25 basis points if you want. I mean, maybe it might be better to go 25. I think Daniel was talking about this. One of the things we want to talk about today is, 50 basis points seems like the Fed might be nervous. It's all how you interpret it, right? The Fed didn't have to do anything. The Fed didn't do anything yet. And look how much they lowered rates just by saying the right thing. That's the power of the Fed. That's why the communication is so important and what they say. We're going to lower rates. 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 We're going to lower rates for 6-7 months. Well, yeah, probably. So inflation's too high. We're going to be data dependent, but we're probably going to lower. The market's been pricing in lower rates for a while. Lower them. I think 50 basis point does a job, but, they might have a good point. That could be seen as a sign of weakness. Maybe the economy is a lot weaker than we believe because the economy is breaking down. It's breaking down to the point where people are starting to struggle right now. They just can't afford prices. I mean, some of these prices are stupid. This is stupid. I mean, you're going into stores and you're going like, get the hell out of here. I got into a fight with my daughter in the store, my 13-year-old. Let's go in. We got bagels. This is Sunday. And if you get one bagel, it's one bagel with egg and cheese, it's $7. So I decided to say, all right, you know what? Let me just get a half dozen bagels, bring one to my family, and it's like $8. I said, we'll make the eggs or whatever. Seriously, because I'm like, it just doesn't make sense, the prices. It's not like, oh, well, if you can afford it or not, it's come on, it doesn't make sense. So I'm like, well, let's just do that. And by the way, in Florida, it's weird. They don't put tin foil around the bagel with the eggs after they cook it. So 5 minutes by the time you get home, it's cold. And I feel like telling them, listen, there's a little bit of there's not a lot of common sense in Florida. It's okay. I won't go there with a rant. Not a lot of common sense in Florida. To me, that makes sense. Charge an extra 10 cents. Charge $20 for your bagel if you want. That's what everyone's doing now anyway. But anyway, my daughter's like, can I have a muffin? And I said, sure, I'll get a muffin. I got my wife a coffee. And it was, their large coffee is like, between a small and a medium. And the price went from $8 to $15. They charged me $7 for a small muffin and like a medium-sized coffee. And I was like, are you fucking kidding me? I kind of got pissed. And my daughter's like, could I get an apple juice? I said, no, we'll get it someplace. She's like, what do you mean I can't get apple juice? I said, no. I said, we'll get it someplace else. I'm going to hand him $3 for something I can get $1 at a store down the block. I mean, it's getting to the point where people are like, F you. I mean, how much are you going to charge? This is ridiculous for some of these prices. They're still trying to get away with them, and I get it. I mean, their businesses are going to go up. Their costs are higher, and they're not seeing as many customers come into these stores now. There was no one in this bagel store on a Saturday. Yes, football started for college football in Florida. It's very big down here with football. SEC, holy shit. It's massive. Like they have every game. They show every game on every channel. It's amazing. It's amazing. I mean, just people felt the bars. It's coming from New York where, college football is like meaningless. It's unbelievable when you get down to the South. Holy cow. It's like a religion down here. It's awesome. Everyone has flags out in their houses. They're wearing shirts, flags on their cars and stuff. It's crazy. Crazy. We're in like Florida County, which is bad because Florida is atrocious. Not as bad as Florida State, though. I don't know how Florida State did it. They managed to make Georgia Tech and USC look like great teams. But USC, I don't know. We'll see. USC's in Penn State division. We'll see about football. Anyway, you guys get my point about prices. But let's see what they come out with. It's going to be interesting. When it comes out with the job report, what is a good number? I would think if it's a strong number, that would be better. Because today we got strong durable goods numbers on the economic front, and it definitely helped the market. I think people were like, okay, it created like a little bit of a base after yesterday's sell-off when if we see another 2% sell-off now you're reading in the papers, tech's going to crash. Now, all the headlines all over the place. Remember, fear sells. Now you have people saying, okay, I'm just going to pull my money out of the market. And by the way, what's different about this market than past markets is you have an alternative to stocks. You didn't have an alternative when interest rates are zero. Where were you going to put your money? If you take them out of stocks, where are you going to put your money? Now you can take out your money and earn 3% risk-free, 4%, 5% in some areas of the market, still earning well over 4% on money markets in international brokers where you have to have a certain amount there. I think it's $100,000, but you could find these rates if you look hard enough, but there's an alternative. That's not a bad return. It's not a bad return. You can say, well, what about inflation? Well, the real interest rate is what then? 1.5 to at least it's not negative. We look at the real interest rate, which accounts for inflation. Inflation is what? 2 point whatever. But there's an alternative. If you're scared of the market, hey, let me take it out. I'll take 3% and let me see if things settle down. You didn't have that when interest rates were at zero. So it's a lot easier if people say, okay, I'm pulling out of the market. I'm going to put my money here for now. That's okay. That's an alternative now. We're seeing the market bounce back today. Again, a lot of these risks that I'm talking about are coming back into the market. Let's see what the jobs report is. I mean, the jobs report is so skewed because, immigrants. And maybe Biden did have it right. Let's let millions of illegal aliens in the country, give them jobs, and we'll have a good, strong job market, which would be great for this. Maybe he's smarter than I think. I don't know. Maybe. But that's going to be a big influence in terms of the data and they didn't say an economist trying to predict this stuff, and the fact that it gets revised every freaking year. 2 million jobs got revised. That will lose. Are you kidding me? I mean, do you even believe this number? I mean, that's a whole nother conversation. I want to get there. When you look at the overall markets, you want to be careful here, but this is an opportunity where not everything is terrible. I mean, you can say consumer names. Look at the dollar stores. I brought up, Dave & Buster's. I brought up Five Below. A lot of these companies getting annihilated. But you know who's not getting annihilated? What about Ross stores? What about TJ Maxx? What about Burlington? Who take the inventory off of the shelves of everyone and resell it. And Burlington, if you haven't been to Burlington, man, Burlington's awesome. I think it's so much better than TJ Maxx, which is the comparison to Burlington. I mean, every time I go in there, I'm buying stuff. They got good brands at really crazy low prices. And my wife's like, can we go to Burlington? I'm like, shit, I don't want to go to Burlington. Come on. Just Saturday, I want to go home. I want to relax a little bit or whatever. And then I go there and then I buy more shit than she does. And she's pissed. I'm like, sorry, you wanted to go here. I'm going out with like 5-6 shirts and everything. I'm like, this stuff's good. It's really good stuff. It's reflected in their stock price. They're doing great. Those companies are doing great. Oil prices are coming down because you're looking globally. I mean, man, people worry about the U.S. slowing down. The rest of the world, holy cow, is it bad out there? I mean, Europe is a disaster. China is a disaster. Japan, it's really, really bad out there. We have high interest rates. We raise rates. Reserve currency. We hurt a lot of countries. We really do. You debate, well, a good dollar, strong dollar, and weak dollar is good for exports, good for imports, or whatever. When we have higher interest rates, other countries do not do good. And China, holy cow, China has done everything that they possibly can to stimulate the economy, and still people are not buying stuff. And they're investing here. They're investing in other places. I mean, it's crazy. And you better be careful, because if you look at some of the stories that are coming out too, and they're sending troops to fight for Russia, holy cow. This stuff is real. Again, stuff that you got to have good contacts, which we do, to see a lot of this stuff that's not reported a lot. But we have weakness around other countries. When you see China doing what's doing, it almost provokes them to try to take over Taiwan or to join with Russia. They really don't like, but then you throw in the BRIC nations and stuff like that. Next thing you know, you have, geopolitical risks get extremely heightened. We have Goldman to lower their copper prices with China and stuff like that. It's supposed to be a positive market. If you're looking all around, you want to be careful. There's ways to protect yourself. You can buy inverse ETFs if you want. We talk about that all the time. Buying puts is really tough. We try to have a newsletter doing that. And even when you're right, sometimes you don't make money on those things. It's hard because of the way the market is. And JP Morgan put out a good report, a really good report today. And not just about the semiconductors. I like the report. I don't agree with it as much. I mean, the comparisons of 2000 are not apples to apples. I mean, the valuations are insane back then. We saw, the amount of money and amount of CapEx spending. It's just, you can say as a percentage, but you're looking at the biggest companies in the world. They had shitty balance sheets back then. I mean, you're looking at big companies that almost went under. They almost went under. Now you're looking at these guys, they're generating like 25, 30 billion in free cash flow. I mean, they're much better positioned. And when we see downturns these days, what happens? They happen so quickly. Like in August, we fell sharply, we fell tremendously, and we bounced back. Even now, 3% loss in one day. I mean, it's much better than 1% one day, 1% the next day, 1% the next day. It is gradual. Even if it's down like 1% a week and you fall 10%, that's 10 straight weeks. And that's where the sentiment changes. With us, it changes like in a second. You get the headlines, market's crashing. AI trade is done. It's over. I just think the AI trade is over for companies that have been bullshitting you all along, like the Intels, like the AMDs, who do not have, like the Salesforce.com, like the Snowflakes, that tell you, whoa, we got a great AIs and corporate bullshit. You're not. Nvidia is. The hyperscalers are. Not everybody is. But we see these big downturns, and the report I was talking about, JP Morgan, they said, look, this could be more of a prolonged downturn with tech, which would not be good for the markets. Pretty obvious, since they account for such a high percentage of the whole S&P 500. But will it be prolonged? Will we see a quick pullback like we do, 10%, 12% pullback? Even in COVID, it was 30 days? 30 days of a massive market crash, and a month and a half later, everything was fine. And we closed down the world. We shut the world. We locked people in their homes. We chased people who were surfing on the beach because they were going to die if they didn't wear a mask. And we turned out okay. Just a quick downturn and we came back. So why am I telling you this? Because you want to be careful here. There's a lot of stocks that shouldn't be trading at the valuations they're trading at. I love small caps here. Yeah, if the economy is slow, small caps usually do poorly. However, they've done poorly already. They've done horrible in the past 3 years, especially related to large caps. So many of these names are down so much. And the risk reward, you could see these things where, if they bounce back, you can see a 30%. You're looking at 2-3x gains. I mean, some really great small caps that I'm looking at are down tremendously. Stop picking away at oil companies. These guys could produce at $50 a barrel, $4 a barrel. They generate tons of free cash flow. These guys are fine. Now, if you used to see oil come down below 60, 50, these guys were just like, they had so much debt. They were done. Now they're buying back their stock. I mean, oil, there's just so much tensions out there. Oil's probably going to go higher from here. We've been saying that for a little while and lost a little bit of money on it, but still, I like the position in oil. I love gold here. Bitcoin pulled back with the markets yesterday. I still think the dynamics, I had my newsletter. The newsletter goes out yesterday, which was a crypto newsletter. I did just the tailwinds behind Bitcoin. It's going to be choppy through September. But I mean, after the election, almost every time after the election, we've seen the last two elections. And by the way, one was Trump, Republican. The other was Biden, Democrat. Just those last two, the average gain over the next 6 months is about 250% in Bitcoin. I won't use 2012 because I think Bitcoin went up like 2,000%. I won't even throw that at you. I think it matters if Trump gets in. He's definitely very, very pro-crypto. I know the Democrats are saying they want to be pro-crypto, but we've seen what they did. I mean, they're actually going after NFTs now, which is just so vague on that definition, guys, when it comes to security. I mean, anything you expect to make money on that gets promoted by a third party, who's a third party? Is it a person on social media? Is it a brokerage firm? Everybody promotes pretty much what they own. And they expect to make money on. There's not one person that buys a crypto that's not buying it to make money on it. So that technically means every single crypto is a security. Every one. But yet you're not providing the guidelines for it. And now you're going after NFTs, which means if you go after NFTs, you'd have to go after collectibles, gold coins, art. I mean, again, when you're vague, when the government has a definition that's vague, it's trouble because they can go after anyone they want, which means they can go after anyone they don't like, who doesn't support their agenda. There's a reason why you're seeing go crazy after Elon Musk. Is Elon Musk really, really a threat to national security? Is he? I don't care if you hate the guy. I don't care how far left you are. Do you really think he's a threat to national security? Really? But what he's done? Rockets. I mean, who shoots off rockets and lands the same rocket? He's done stuff what NASA couldn't do for hundreds of years. Well, I should say, more like 50 years. Electric vehicles, where would we be without him when it comes to the electric vehicle market? Is he a threat? Is it really a threat to national security? You say, I hate his guts. I hate him because he likes Trump and he's supporting Trump. The platform, people are going to say what they want or whatever. And you can say what you want. Is he a threat to national security? Come on. With the bullshit. But when you have vague definitions when it comes to the government, it allows you to go after anyone you want, which is crazy. But getting back to the markets here, be careful. You do have an alternative. You could throw it into treasuries. You could throw it into money market funds. Make sure wherever you're at that money market fund, no matter brokerage that you have, pays a high yield. They should pay a high yield in the money market fund. If not, put it someplace else because there's no difference with what platform you use. Other than preference, well, this is nicer. I like this. This is easier. Robinhood's easier. They're all the same. Doesn't matter. But right now, start doing your homework. We just saw earnings come out. So a lot of companies report, and even companies that reported good numbers saw their stock come down. I mean, buying low expectation stocks seems to be good. I would not dollar stores or Dollar Tree or anything like that. I do like some of these names now after, I didn't like Dollar Tree, but Dollar Stores, yes. I mean, it pulled back tremendously and they had $1.4 billion on that buyback. They didn't buy back any shares last quarter. Good for you, for a management team, where Snowflake bought back $1.5 billion of their shares, all at much, much, much higher prices. You're doing your shareholders a great deal there. That's a good job. These guys are like, no, we see the shitstorm coming. We're going to see things get worse. Let's wait. Let's buy our stock back when it's 30% lower. Good job by management. Yes, it's a tough market. Yes, your stock went down. Yes, you're a shareholder, you're pissed. But man, that $1.4 billion, what do you think they're going to do right now? That's like 6-7% of the float. So they start buying the shit out of it. You see if they slow down, you see just not even good results. You don't need good results. Forget great results. You just need less than bad results for dollar stores. And that stock's going to pop 15-20%. And you have that nice floor, that big buyback that they have, which I don't know if Dollar Tree has that. I didn't look too much into detail. Just those tornadoes and shrinkage. I love that term so much. But start doing your homework on names that you want to buy 10, 15% low. We say this every time the market pulls back. If I could reach out and just strangle you and say, listen, this is what I tell you to do for the last 10 years of every single market pullback. Start looking at names that you would buy in a 10, 15% pullback from here. And if you've done that over the past 10 years, holy shit, have you done great. And I hope that's why I do this podcast for. I want you to do great. I don't want to pat myself. I don't give a shit. I'd rather be wrong and see you make money than be right and see you lose money. I'm being dead honest. But when times like this, especially when we've seen with past markets, when they pull back right away. When they pull back, see what you want to buy. There's some names. I mean, look, you're looking at Smith Micro with the accounting concerns is not the same as, Nvidia pulling back. It's not the same as, maybe AMD pulls back a lot further from here and it becomes a buy. I just think it's very expensive. And I said that when it was well over 200 and it fell tremendously from there. Could they get it right? Absolutely. Are they busting their asses to try to get it right? Absolutely. But they haven't yet. They haven't. I mean, Dell and Supermicro and just their AI solutions are let's give it away cheaper than everyone else, even though we're slower than everybody else. And our margins, we're going to sacrifice margins. And, they got hit because of that. I mean, Dell was up tremendously before they got hit. But there's different companies, like people like, the retailers are dead. Are they dead? Because I know Walmart's not dead. Target's not dead after that quarter. Ross, TJ Maxx, Burlington's not dead. But I can name a bunch of retailers, which I already named, that are having trouble. There's good oil companies that have great balance sheets that are going to be buying back their stock like crazy right now. Look at that. See which ones are hedged at much higher prices. The low price isn't going to hurt them as much. How long are they hedged for? Look at the Pioneers, the UG Resources, companies like that. They have a history of hedging a lot of their production. They probably hedge it at $75, $80. If they did it, well, probably around $75. But start doing your homework. That's how you want to embrace these types of markets, especially when all the fear's out there. Again, everything I'm telling you, we already know. So a lot of this is factored into stocks. Okay, it's very easy to promote, especially if you're a newsletter guy. You're going to see, holy shit, are you going to see the fear? It's done. AI's done. We're going to get crushed. The markets, the debt levels, everything. Holy shit, you're going to die. Move your money out of the country right fucking now, right now. In the meantime, the guy's telling you that gets paid by a company his check goes right into the bank. He probably went to the bank the day before. Move your money from the banks right now. They're going to scare the shit out of you. Use it to your advantage. Know what's coming. It's not difficult to see all the fear packages and the fear shit that's coming. Everybody's mentioned on CNBC. It's only a 3% downturn. Everybody thinks the world's over. It's going to crash. You could say, well, Frank, if it did pull back 10%, but it's 10% off of, a market cap that was, what, 500 billion a couple of years ago? That's 3 trillion. And it pulls back. That's fine. But there's going to be pockets of growth. There are going to be pockets that make sense here. I think gold junior miners, you're going to see, I'm going to start recommending a ton of those. Holy cow, they're left for dead. Left for dead. These people, so many good money managers, it's not money managers, so many good managers, I say, as CEOs, especially in the junior mining industry, right? Which is a shitty industry and 90% is garbage. But a lot of those guys busted their ass to buy assets at dirt cheap prices over the past 10 years. That are now sitting and they said, listen, if we had gold go to 2,000, our stock's going to freaking quadruple. It's at 2,500 and their stocks are lower than they were 3-4 years ago for some of these names. I'm like, holy shit, because no one's just interested in them. They are going to get interested, especially since you're going to see this redirection of allocations. I mean, you don't really see money flow completely out of the market. It's got to flow someplace or money managers can't generate fees. So they're going to look at other sectors. You're seeing, defensive companies, utilities picking up. Again, it's just a little bit of a shift into other sectors. Okay, we were way loaded in tech for too long. We're coming out of tech. Where's the money going? I think it goes to oil. I think it's going to go to gold. Some of it's going to crypto, small allocations, especially now you have institutions and 401ks allowed to own this stuff. That's where you want to be looking. And if you listen to our podcast, Wall Street Premium, Dan and I cover stocks, tons of stocks. We give away so many stocks and reports just telling you, hey, this looks good. Look at this company. It's just little things that, you're not going to get just by reading a story because, some media channel needs content and they need to put out, Nvidia's down. It's because you're going to see a slowdown and AI spending. We dig into that and say, hey, we're not seeing it. We could, maybe there's a slowdown in spending to other names. We're not going to see it to Nvidia anytime soon. But there's certain names that are going to benefit and others that don't. And that makes the stock pickers market. It's nice to see not every stock within one sector goes higher. I mean, retail is a great example of that. Oil is a good example of that. Not every oil company is getting smoked right now, but it's a lot of good names in that industry. Probably show up in our newsletters as well. But this is the time that you bust your ass and do work, because if you're a smart investor, if you're a good investor, the greatest investors embrace markets like this. They love it because when the market comes down and you're sitting on cash, you're able to buy stuff much cheaper. Look at Warren Buffett, greatest investor ever lived. Yes, he's selling Bank of America, but when did he buy Goldman Sachs during a credit crisis? Right? When does he buy a lot of these assets? He buys assets where people come to him and he's able to offer deals that he's almost guaranteed to make money, like during the credit crisis. That's what the BlackRocks do. A lot of private equity firms do. So you want to focus on the names. Easy to find data on this stuff. We use briefing.com. I don't get paid by them. It's really cool to see all the reports. You just fly on the wall or whatever, or you just dig into some of these companies, see what's going on, or Wall Street Unplugged Premium. $10 a month only. I mean, and you get access to our trading newsletter, which it's a $5,000 newsletter any place else in the industry that you're getting for $10 a month. But there you're getting ideas where we're able to take advantage of the disconnects on as it happens daily, not monthly, which is really cool. I really like that portfolio. I like that newsletter a lot, actually. Because Dan and I talk about so many ideas, and we're like, well, this company shouldn't be down as much. Or, you should be buying this, even though it's up 10, 15%, because it's cheaper now than it was before they reported earnings, because they blew out their earnings expectations. But start doing your homework. Don't just fall away and say, I'm getting out of the market. If you have cash on the sidelines, again, you want to start looking and say, these are the names I really, really like. I want to see a pullback, because when you see an overall market pullback, a lot of stocks, even the good names, pull back. That gives you an opportunity to buy them. So hopefully you guys enjoyed the podcast. Dan will be back tomorrow on Wall Street Unplugged Premium, and I'll see you guys then. Take care. Love this episode of Wall Street Unplugged? I think you'll really love Wall Street Unplugged Premium. The Wall Street Unplugged Premium is my members-only podcast where I dive even deeper into this week's events. Well, I'll do even more than tell you what's moving these markets. I'll tell you specifically what moves you can make today. So this is going to be about trading. Put big money in your pocket right away due to the inconsistencies I see daily in the market. I'm talking about specific investment ideas I'm recommending and tracking each week that I believe will be impacted directly by everything I just talked about today. Plus, you're going to get the chance to go even further down the rabbit hole with me and my co-host, who's Daniel Creech, as we discuss which of these week's trends could turn into massive windfalls. The big trends that we see lurking on the horizon, also the news we're picking up from our network of insiders, which has gotten bigger and bigger thanks to you and so many people listening to this podcast in over 100 countries. And you get a chance to talk to me directly in my special Ask Me Anything Q&A session. All of that and a lot more, like premium interviews with world leaders in finance, technology, industry, and politics. This is all part of Wall Street Unplugged Premium. And becoming a member is super simple and super cheap. So head on over to WSUoffer.com to check it all out. Sign up today, and you won't miss a thing. That's WSUoffer.com.
Wall Street Unplugged is produced by Curzio Research, one of the most respected financial media companies in the industry. The information presented on Wall Street Unplugged is the opinion of its host and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility.